Ladies and gentlemen, welcome to another Warta update. Today we published financial year 2021 figures and we link that to an outlook for the ongoing year and of course to the longer perspective to 2023 and the years to come. Let us first jump into the performance of 2021 on two slides. First, we came in solidly with an organic growth of 3.8% as predicted, close to 903 million as forecasted. The adjusted EBITDA, and there is not much adjustments behind, so you can just transport that to the regular EBITDA, comes in at 283 million. That is plus 17%. So you see an overproportional increase in the profitability, and therefore the EBITDA margin jumped at the level of 31.3%. This gave us, I would say, a solid base to decide on the dividend proposal. We will give back to the shareholders €2.48 per share. This is on the same level as last year. What is driving our business? Ongoing technology leadership, innovative products, and a strong brand. We are strong positioned. Ongoing pandemic, COVID-19 pandemic still is making no big impact on our business. However, the impact from the Ukraine, we have to keep in mind that is an ongoing war which is fluctuating all the surrounding of our business. I will come to that in a second later. And of course, we already started the next growth initiative, which I touch in a second. With this, go into the Warta House. You know that we have two strong segments. On the left-hand side, the lithium-ion solutions and microbattery business, which stands for 57% of group revenue. The second one is the household business, which stands at 43%. The left hand, or you might know, a micro business we serve as a provider for hearing aids. The coin power business jumps into the TWS. The lithium-ion solutions, that is a power pack business. The V4 drives, that's our future. On the right-hand side, the consumer is a AA, AAA battery business format, which you use in your remote control. That if you have a PV system on the roof on your home, you might use a storage system to store the energy which is produced coming from the sun. When you look into the adjusted EBITDA, nearly 75% is coming from the larger business segments, the lithium-ion and microbattery business. The smaller proportion is coming from the household. And of course, the EBITDA margin significantly jumped. We already saw that on the group level. What is our, I would say, performance and our positioning in the global markets? You can see on the left-hand side, in three areas we are globally, or at least Europe-wide, the clear number one. That's the hearing aid business. That is for the TWS business. And the consumer business, we are a leader in Europe. Top 10, those are the two speedboats within our portfolio, the power pack business and the energy storage. They grow with more than 30% year by year. So I would say in the near future, they will become, I would say, a dominant player within our portfolio. With this, I want to touch the future. Where is the growth coming for this year and the years to come? There are three elements. The first one, the traditional lithium-ion business. What we see as a prediction, starting with 2021 figures, is a growth pattern in the range of 13 to 50% year over year. And this will end in 2024 in a range of 1.3 to 1.4 billion in revenues. You see the mix. The mix is ending in 2024 nearly at a 50-50 range. So lithium-ion business is still taking the lead and non-lithium-ion business will kick in with 45%. Both, I would say, chemistries are, I would say, adding to 100% of our business. So this business is continuously growing. This is a solid base. This is predictive, and we are in the end consumer market active. If we jump into, I would say, the new segments, we touched that in former sessions. The larger format cell, which is a round cell, we call that 21700. That is more technology-driven aspect, or we call that V4 drive. The first use case is in the e-mobility. The left-hand side, we see what the market needs. It's not really a big surprise. It's huge in gigawatt hours. Every car maker needs and pushes, I would say, the battery. So this is the biggest appetite coming from this side. What we developed so far. Currently, we successfully ramped up our pilot line. It's producing 10,000 cells per week. It is now installed in cars. It is tested under heat circumstances in very cold areas. So the test set continuously, and we as well have enough batteries, I would say, to showcase other potential clients. No ongoing negotiations. That means we have not yet signed, but we are making progress in that area with other OEMs. And we will certainly, I would say, give more details once we have those contracts in our house. We started as well the development of larger form factors. The 21700 is a relatively small, or I would say slim battery format. It could go up to a 46800, which is a much bigger battery. And this covers more energy, which goes into, I would say, the fully electrified cars. And so we will have in the near future a full portfolio of different battery factors. And of course, we utilize our existing system know-how. When we look into what is as well an attractive market, and that is the third growth driver beyond the automotive, you can say the non-automotive, but it's, I would say, to differentiate, it's, I would say, 4 segments which are of major interest for us. If you look at that, it comes from the home appliances, it goes into the non-automotive, but still mobility, it goes into the power tools and energy. So lots of use cases, which are all attractive markets for our larger format cell. Once we have decided to, I would say, follow those 3 growth stories, the question is how we can finance that. If you read that from left to right, you see we currently have a solid equity ratio with nearly 43%. Consequently, the net debt to EBITDA is relatively low. It is below 1, exactly it is 0.8 times. So if we want to stay investment grade, and of course this is our target, then we can go up to 3 times net debt to EBITDA, which would consequently give us another headroom of 560 million. So if we now move to the right-hand side, you see the illustration. We start with the net debt currently of minus 230 million. We can gain, increasing the leverage to 560, and 200 for each year will come in from the recurring operational cash flow from the existing business, which sums up for 1 billion. What we are doing with that 1 billion, which we have potential as firepower, again, left-hand side, you see ongoing investments, could go up to 280 million this year. We have a range dedicated 230 to 280. And of course, we do the payment for the dividends, which needs 100 million. So what to take for the outlook and the guidance? Clearly, 2022 started with lots of challenges for us, but you as an investor need to get, I would say, answers for the biggest 3 challenges of our company. If you read that from left to right, you see no direct impact. So the first topic is chip shortage. Clearly, our clients suffer from that, but we do not. No direct impact from COVID-19. We handle that. We have challenges, but currently our business is ongoingly. We have no interruption, no disruption on our business, on our production lines, and no shortages of raw materials. It's fair to say that the prices are increasing, but we get what we need. On the right-hand side, you see that we currently have a limited impact to the trouble area with the Ukraine crisis, the Ukraine war, with the countries Russia, Ukraine, and Belarus. Currently, we ship less than 1%. That is mainly consumer business, but we have no, I would say, sourcing from the raw material, and we have no plants over there. So it's a very limited risk. Clearly, we see the risks that our clients might decide to shift their chips because they are short of chips, that they shift that to other products with higher margins. We could suffer from that. That is an existing, I would say, challenge for us. And COVID, of course, could, I would say, hinder our clients to produce. So having said that, what we expect for 2021, we expect revenues in the range of 950 to 1 billion, adjusted EBITDA in the range of 260 to 280 million. We started relatively lower than expected in the first quarter. So the first quarter, we expect in the range of 180 to 190 million in the revenues, and you see the equivalent adjusted EBITDA, which we expect in the range of 34 and 39. And we discussed already, I would say, what impacted us as well. So to keep in mind, on the left-hand side, what is our business outlook? Technological leadership, innovative products, strong brand, ongoing. That is our strategy, very well positioned in the market. We see the risk, we can handle the risk by our own, but we might be hit from our clients, which were, I would say, suffering more from those crises. But we have no standstill. The next growth initiative is under full steam. So we, I would say, develop larger format cells. We are in strong negotiations with potential clients, and first revenues we still expect in 2024. And with this, I want to give back to Sanja, and thank you very much for listening.
Since you watched this company video until the end, I'm guessing you liked the video. That's probably because we work very hard to create the most engaging and value-added content possible for you. If you're a stock-listed company or corporation and want to find out how we at C11A can make a company video with and about you, please email us at community@c11a.com.